Keurig Dr. Pepper's $18 to $18.4 billion acquisition of JDE Peet's. Strategic rationale, investment structure, plan separation, market and consumer trends, and strategic outlook. Detailed synopsis. Keurig Dr. Pepper's, KDP, planned $18 to $18.4 billion acquisition of JDE Peet's is the most transformative beverage industry deal in years. Supported by a $7 billion strategic investment co-led by Apollo Global Management and KKR. This transaction not only shifts the competitive dynamics of the global coffee and beverage sectors, but also marks the launchpad for KDP's separation into two new, U.S.-listed pure-play companies, Global Coffee Company and Beverage Company. The acquisition will create the world's largest coffee-focused enterprise and a leading refreshment beverage platform in North America, each with distinct, focused growth strategies and investor value propositions. This report delivers comprehensive coverage across all dimensions of the transaction. The financing structure, anticipated synergies and cost savings, capital structure and leverage, investor sentiment and credit ratings, M&A market trends, evolving consumer coffee behaviors, especially at-home consumption and ready-to-drink, RTD growth, plus detailed business overviews of both KDP and JDE Peet's. Special focus is placed on how shifting consumer preferences and global market momentum have influenced deal rationale and will guide future growth opportunities for both resulting entities. The report is followed by a full, originally worded podcast script suitable for publication, as well as an informational disclaimer. Full research report. 1. Introduction. The genesis of a transformational deal. In August 2025, Keurig Dr. Pepper, a category leader with over $15 billion in annual revenue, announced its intent to acquire JDE Peet's, Europe's listed pure-play global coffee leader, for an all-cash deal valuing JDE Peet's at approximately $18 to $18.4 billion, reflecting a 33% premium over JDE's 90-day VWAP. This all-cash tender offer is supported by strategic bridge financing, underwritten by major lending institutions, and will be followed by a plan to separate KDP into two independent, U.S.-listed companies, a global pure-play coffee company, Global Coffee Company, and a North American refreshment beverage challenger, Beverage Company. What makes this transaction unique is not only its scope, unifying the strengths of two beverage powerhouses and distributing their assets into focused pure plays, but also the capital innovation that enables it, a $7 billion strategic investment, split between a pod manufacturing joint venture and preferred equity, co-led by Apollo and KKR. This initiative both reflects and propels broader trends in global beverage sector consolidation, premiumization, and product innovation amidst rapidly evolving consumer habits. 2. $7 billion strategic investment structure, deleveraging through innovation. A cornerstone of the transaction is the innovative financing solution secured by KDP. Recognizing the market's concerns around excessive leverage and balance sheet vulnerability amidst volatile market conditions, KDP structured two major capital injections from Apollo and KKR, designed explicitly to optimize the company's capital structure at closing and to preserve investment-grade credit ratings. Breakdown of the $7 billion capital solution. This structure achieves several goals. Deleveraging. Proceeds directly retire acquisition debt, targeting a net leverage of 4.6x at close, 1.0x less than initially modeled, originally upwards of mid-5x range. Strategic partnership. Long-term alignment with sophisticated investors with sector depth, building credibility and operational value add. Cost efficiency. The blended cost of capital remains competitive, especially compared to alternatives in contemporary debt markets. This innovative structure is both a response to and a model for large-cap M&A in the current market climate, balancing liquidity, flexibility, and cost considerations. 3. The acquisition, strategic rationale, and deal mechanics. KDP's acquisition of JDE Peet's is a power play by almost any measure, uniting North American single-serve and RTD coffee leadership with a global presence that covers over 100 markets, 50-plus brands, and number 1 or number 2 share in more than 40 countries. Key elements. Valuation. €31.85 per share in cash. Total equity consideration of €15.7 billion. Enterprise value close to $23 billion. Synergies. $400 million in targeted annual cost savings, fully realized within 3 years post-close, driven by supply chain, procurement, logistics, and SG&A optimization leveraging both AI and global scale. Accretion. Expected double-digit, 10%. EPS accretion in year 1 post-close, with further upside from synergy realization and operational leverage. Scale and market impact. Creation of a $16 billion global coffee leader and an $11 billion agile beverage challenger, both engineered for high single-digit EPS growth and mid-single-digit sales growth. Deal structure and timeline. Fully underwritten bridge credit agreement by Morgan Stanley and Mitsubishi UFJ Financial Group, totaling €16.2 billion. Transaction closure and commencement of post-close integration targeted for the first half of 2026. Separation into two companies operationally ready by end of 2026. Strategic fit. JDE Peet's offers a globally diversified base in retail, away from home, and e-commerce coffee, as well as a balanced blend of global, regional, and local brands. KDP contributes unrivaled U.S. single-serve and RTD expertise, plus core distribution and DSD scale. This complementary fit is designed to meet global consumer needs across traditional and specialty coffee, RTD innovation, functional and plant-based trends, and both premium and mass channels. 4. Planned separation into global coffee company and beverage company. Value unlocked. The second major pillar of the strategy is the separation of the combined entity into two focused, U.S.-listed companies. For point 1, Global Coffee Company. Profile. Scale, $16 billion net sales, $3 billion plus EBITDA. Portfolio, flagship brands Keurig, Jacobs, L'Or, Peet's, plus dozens of regional powerhouses. Market, number 1 pure-play coffee company globally, operating in 100-plus countries with leadership across specialty, single-serve, instant, and away-from-home channels. A growth model, steady, cash-generative, with reliable dividend, share buybacks, and a focus on innovation, cold brew, RTD, functional, and sustainability. Capital structure, net leverage target 3.75, 4.25x at separation, investment grade profile. For point 2, Beverage Company. Profile. Scale, $11 billion net sales, $3.3 billion EBITDA. Portfolio, market-leading brands in North American beverages, Dr. Pepper, Canada Dry, 7-Up, A&W, plus fast-growing entries in energy/functional, water, and sports hydration, electrolyte, Ghost Energy. Network, highly differentiated DSD and distribution assets in the U.S., Mexico, and Canada. Growth model, high-growth platform leveraging a proven build, buy, partner, model, attractive dividend, and capital-efficient portfolio evolution. Capital structure, net leverage target 3.5, 4.0x at separation, also supporting investment-grade status. Separation mechanics, executed as a tax-free spin-off of Global Coffee Company to KDP shareholders. Two independent companies, bespoke capital structures, management teams, and boards. Operational and governance readiness by end 2026. This intentional separation is designed to maximize value by providing investors with high conviction, sector-specific options, either pure-play coffee growth or broad-based beverage innovation. 5. Financing and leverage impact, balancing growth and risk. The financing package underlying this transaction is both innovative and responsive. As detailed above, the $7 billion Apollo KKR capital infusion is structured to quickly deleverage. Net leverage a close estimated 4.6x, compared to prior estimates of 5.6, 6.0x, and to allay market and agency concerns over investment-grade preservation. 5.1. Pre- and post-deal capital structure. Debt composition. Initial bridge comprised of both senior unsecured, lower rate, liquid, and junior subordinated debt, higher yield, riskier, plus sustainment via KDP cash and JV equity. Use of proceeds. Immediate application to reduce acquisition debt and optimize cost of capital. Leverage ratio trajectory. Management targets for both companies of sub 4x within 2 years post-separation, mirroring historical KDP deleveraging from 11.5x to 2.9x after the Dr. Pepper Snapple Keurig merger. 5.2. Credit agency response. Current agency action. S&P, Fitch, and Moody's all placed KDP credit on negative watch following the August deal announcement, citing temporary leverage expansion as the principal risk. Outlook. S&P expects a one-notch downgrade, likely to BBB. Conditional on successful deleveraging below 4x within 24 months post-close. Mitigants. Management's explicit commitment to prioritize debt reduction, cost synergy capture, and further non-core asset sales as necessary. Key risks include execution risk on post-deal cost synergy realization, $400 million over 3 years. Integration complexity and separated management. Macroeconomic headwinds and commodity input price volatility. In summary, KDP's financial solution is both ambitious and risk-managed, aiming to preserve capital market access and deal credibility throughout the transition. 4. Planned separation into global coffee company and beverage company. Value unlocked. The second major pillar of the strategy is the separation of the combined entity into 2 focused, U.S.-listed companies. For point 1, Global Coffee Company. Profile. Scale, $16 billion net sales, $3 billion plus EBITDA. Portfolio, flagship brands Keurig, Jacobs, L'Or, Peet's, plus dozens of regional powerhouses. Market, number 1 pure-play coffee company globally, operating in 100-plus countries with leadership across specialty, single-serve, instant, and away-from-home channels. A growth model, steady, cash-generative, with reliable dividend, share buybacks, and a focus on innovation, cold brew, RTD, functional, and sustainability. Capital structure, net leverage target 3.75, 4.25x at separation, investment-grade profile. For point 2, Beverage Company. Profile. Scale, $11 billion net sales, $3.3 billion EBITDA. Portfolio, market-leading brands in North American beverages, Dr. Pepper, Canada Dry, 7-Up, A&W, plus fast-growing entries in energy/functional, water, and sports hydration, Electrolyte, Ghost Energy. Network, highly differentiated DSD and distribution assets in the U.S., Mexico, and Canada. Growth model, high-growth platform leveraging a proven build, buy, partner, model, attractive dividend, and capital-efficient portfolio evolution. Capital structure, net leverage target 3.5, 4.0x at separation, also supporting investment-grade status. Separation mechanics, executed as a tax-free spin-off of Global Coffee Company to KDP shareholders. 2 independent companies, bespoke capital structures, management teams, and boards. Operational and governance readiness by end 2026. This intentional separation is designed to maximize value by providing investors with high-conviction, sector-specific options, either pure-play coffee growth or broad-based beverage innovation. 5. Financing and leverage impact, balancing growth and risk. The financing package underlying this transaction is both innovative and responsive. As detailed above, the $7 billion Apollo KKR capital infusion is structured to quickly deleverage. Net leverage a close estimated 4.6x, compared to prior estimates of 5.6, 6.0x, and to allay market and agency concerns over investment-grade preservation. 5.1. Pre- and post-deal capital structure. Debt composition. Initial bridge comprised of both senior unsecured, lower rate, liquid, and junior subordinated debt, higher yield, riskier, plus sustainment via KDP cash and JV equity. Use of proceeds, immediate application to reduce acquisition debt and optimize cost of capital. Leverage ratio trajectory. Management targets for both companies of sub 4x within 2 years post-separation, mirroring historical KDP deleveraging from 11.5x to 2.9x after the Dr. Pepper Snapple Keurig merger. 5.2. Credit agency response. Current agency action. S&P, Fitch, and Moody's all placed KDP credit on negative watch following the August deal announcement, citing temporary leverage expansion as the principal risk. Outlook. S&P expects a one-notch downgrade, likely to BBB. Conditional on successful deleveraging below 4x within 24 months post-close. Mitigants. Management's explicit commitment to prioritize debt reduction, cost synergy capture, and further non-core asset sales as necessary. Key risks include Execution risk on post-deal cost synergy realization, $400 million over 3 years. Integration complexity and separated management. Macroeconomic headwinds and commodity input price volatility. In summary, KDP's financial solution is both ambitious and risk-managed, aiming to preserve capital market access and deal credibility throughout the transition. 8. Beverage sector M&A. Market dynamics and outlook. The KDP JDE Peet's transaction is emblematic of recent acceleration in beverage sector M&A. Following a lull from 2022 to late 2023, deal values and volumes resurged in 2024 to 2025, with larger deals driven by the twin search for scale and growth platforms in premium/functional beverages and coffee. Recent trends. Anti-alcohol sentiment fueling premiumization and RTD growth, while traditional alcohol volumes lag. Strategic buyers leading 77% of deal volume, with private equity returning to the sector for the first time since 2021. M&A and divestitures focused on specialty, plant-based, and wellness beverage assets. The KDP JDE Peet's deal, together with prior Coca-Cola, Costa Coffee, and Nestle Blue Bottle deals, is widely seen as a blueprint for future beverage consolidations, melding traditional market power with innovation and rapid-scale deployment across channels and geographies. 9. Evolving consumer behavior. At-home coffee and RTD surge. 9.1. At-home coffee, durable shift, premium growth. Key trends identified. At-home dominance. 87% of traditional coffee drinkers and 74% of specialty drinkers now brew at home, accelerating since the pandemic and not fully reverting to pre-2020 out-of-home shares. Single-serve growth. Single-cup brewing maintains 60% plus market share in U.S. homes in 2025, driving penetration and recurring revenue for brands like Keurig. Specialty surge. Specialty coffee consumption hit a 14-year high in 2025, with 66% of Americans drinking coffee daily and 64% of 25 to 39-year-olds consuming specialty formats weekly, a record. Health and wellness. Interest in wellness now heavily influences purchase intent. Over 61% of specialty drinkers believe coffee is good for health. Lower sugar, plant-based, and functional coffee products see double-digit growth. 9.2. Ready-to-drink, RTD coffee, the fastest-growing segment. Category size. RTD coffee now exceeds $37 billion globally, on track for $52.5 billion by 2034 at a 7.2% CAGR. Drivers. Convenience, flavor innovation, e.g., cold brew, plant-based options, added protein, eco-friendly packaging, and functionality, adaptogens, energy claims. Demographic pull. Millennials and Gen Z are overrepresented, valuing both convenience and wellness. 9.3. Implications for KDP JDE Peet's. The combined company will have leadership presence in every rising coffee segment. Single-serve, Keurig, RTD, La Colombe, Peet's, JDE Peet's RTD lines, and specialty premium, Lore Peet's Jacobs. Cross-pollination opportunities exist. Introducing single-serve and pod technology to JDE Peet's global markets, expanding RTD production and distribution, and leveraging the combination of R&D to create new functional/premium offerings. 10. Competitive landscape, a new global challenger. 10.1. Coffee sector. The KDP JDE Peet's combination will establish the world's largest pure-play coffee player by sales, $16 billion plus, leapfrogging existing leaders including Nestle and Starbucks in at-home and RTD channels, while maintaining a robust away-from-home business. Portfolio strength. Over 50 iconic brands, leadership in single-serve, specialty, and instant, plus global manufacturing and distribution scale. Competitors will respond. Starbucks and Nestle have already accelerated RTD launches and market partnerships in direct response to these trends. 10.2. U.S. beverage sector. Beverage company will be the fastest-growing, most agile challenger in North America, with an unrivaled DSD system, innovation in energy and functional beverages, and a model engineered for attracting and scaling emerging brands. Competitive set includes Coca-Cola, exploring Costa Coffee divestiture, PepsiCo, recent M&A and wellness brands, and a fragmented but fast-evolving ecosystem of RTD and specialty players. 11. JDE Peet's and KDP. Business overviews. 11.1. JDE Peet's, the largest global pure-play coffee and tea brand platform, with over 50 brands, sales of €8.8 billion in 2024, and presence in over 100 markets. Brand strengths: Peet's, L'Or, Jacobs, Do Egberts, Kinko, Pilau, Moccona, Caribou Coffee, and more. Strategic focus: Common Grounds ESG program, targeting 100% responsible sourcing and 43% carbon emission reductions by 2030, €500 million productivity initiative, and market-expanding M&A. 11.2. Keurig Dr Pepper, the leading North American beverage company, $15+ billion annual revenue, 125+ owned and partner brands. Brand portfolio includes Keurig, Dr Pepper, Canada Dry, 7-Up, Snapple, Green Mountain, Mott's, A&W, Ghost, and others. Innovations: #1 single-serve brewing system in U.S. and Canada, broad DSD platform, rapid energy and RTD expansion, and partnerships with buzzworthy growth brands. Financial profile pre-acquisition: 2024 to 2025 7 to 10% net sales growth, strong free cash flow, and a multi-year record of deleveraging and capital efficiency. 12. Strategic outlook for the combined entity. For Global Coffee Company, durable, sector-leading platform in the most resilient CPG category. High barriers to entry and robust R&D funnel for innovation in specialty, functional, and RTD coffee. Unparalleled scale in global procurement and ESG leadership. For Beverage Company, a growth-oriented challenger with a record of agile, capital-efficient evolution. Proven playbook for acquiring, building, and scaling high-velocity brands, particularly in functional, wellness, and energy segments. Future runway for DSD expansion, digital transformation, and portfolio optimization through additional M&A or partnerships. Both companies, through focus and independence, are expected to deliver above-peer growth, sector-leading margins, sustained cash returns, and compelling investor value. 13. Podcast script: Brewing Bold Moves, the Keurig Dr Pepper, JDE Peet's acquisition story. Intro music bed: upbeat modern. Welcome to Brewing Bold Moves, the podcast where we unpack the biggest stories shaping global food, beverage, and consumer trends. I'm host name, and in today's episode, we're spotlighting a transaction that's sending ripples across the beverage world. Keurig Dr Pepper's $18 billion acquisition of JDE Peet's and the bold plan to split into two focused powerhouses, one for coffee, one for refreshment beverages. Teaser: how does this blockbuster deal reflect the way we all drink coffee now? Why would two giants want to go their separate ways right after joining forces? And what does it mean for global coffee lovers, employees, investors, and the future of at-home brewing and RTD innovation? Let's dig in. Segment 1. Setting the stage. This isn't just any acquisition. Keurig Dr Pepper, known for turning your kitchen into a cafe with its single-serve brewers and iconic soft drinks, is preparing to buy JDE Peet's, the European titan behind brands like Peet's, L'Or, Jacobs, and Do Egberts. We're talking about blending North America's coffee innovation with a global cafe presence spanning over 100 countries. But that's just chapter 1. Shortly after the deal closes in 2026, KDP plans to split the coffee side in a global coffee company, a $16 billion global leader, and the rest in a beverage company, aiming to reshape the refreshment drinks market with $11 billion in sales. Segment 2. Financing. Not just big, but smart. To help fund the buyout, KDP secured a $7 billion strategic investment led by the private equity giants Apollo and KKR. This money goes two ways. $4 billion red light, green light, into a joint manufacturing venture for K-Cup pods, where KDP stays in the driver's seat. $3 billion convertible preferred shares, smart money, with a premium baked in, keeping balance sheets in check, and reassuring wary credit agencies. Investors were worried about debt. After all, big deals bring big bills. But this two-part capital plan pulls down KDP's post-acquisition net leverage to 4.6x, about a full notch lower than the sector feared. Segment 3. Why this? Why now? Why is KDP doing this? Scale and synergy, bringing together North American single-serve leadership and global traditional coffee. Synergies. Think $400 million in cost savings. Come from sharing logistics, procurement, and innovation muscle. Trend riding. Coffee is changing fast. Specialty consumption is at an all-time high, and RTD coffee is rocketing thanks to millennials and Gen Z who want cold, convenient, healthy options. At-home brewing still dominates, but consumers crave variety. Plant-based, low-sugar, functional ingredients. Future focus. Splitting the business means sharper focus. Global coffee company can go all in on coffee, leveraging strength from K-Cups to cold brew. Beverage company becomes more nimble, scaling brands like Dr. Pepper, 7-Up, and fast-growing energy drinks, and building the DSD networks that get products on shelves first. Segment 4. The complex market response. The stock market's mood? Mixed at first. KDP shares dipped on fears the company was taking on too much debt. But after the Apollo KKR investment was announced, sentiment swung. Investors see the logic, reduce risk, keep investment-grade credit alive, and line up the right partners for innovation. Analysts say this could trigger a wave of beverage sector deals, just as big soft drink players have snapped up specialty brands or pivoted to functional and low-sugar products. Segment 5. Consumer impact. Your coffee reimagined. If you're a coffee drinker, here's what all this means for you. Expect more choices at home and on the go. From classic roast to innovative formats like cold brew in cans, protein-boosted lattes, or RTD coffee blends. This new company aims to win both convenience shoppers and coffee aficionados. Sustainability and wellness are front and center. Both legacy businesses have strong ESG commitments, responsible sourcing, recyclable packaging, lower emissions, and wellness-minded product R&D. Pricing and availability? With scale comes efficiency, but also the chance to innovate faster, meaning more specialty trends hit mainstream shelves sooner than ever. Segment 6. Outlook, risks, and opportunities. This isn't a set-and-forget deal. There's integration and execution risk. Cost synergies must be realized, debt managed down, and two corporate cultures blended and then re-separated. Commodity volatility and consumer mood swings are always wild cards. But if KDP executes well, global coffee company and beverage company will each have room to focus, grow, and invest, possibly outpacing many rivals. Segment 7. The last word. Coffee keeps fueling our days and the global beverage business.